Dear professors, I'm Yuying Gao, a PhD candidate from Gachon University, majoring in global business. It's my great honor to attend this academic conference. The paper for this conference was jointly written by me and my professor, Professor Shanyue Jin. The title of this paper is The Incentive to Hold Financial Assets, Enterprises, Financial Risk, and Innovation Activities. Next, I will give a brief introduction of the main contents of this paper. This paper contains 6 parts: introduction, background and hypothesis, data and variable, model, research model, results, conclusion, and recommendations. Now look at the part 1, introduction. According to the new economic growth theory, technological progress and knowledge accumulation are the core drivers of economic development. China has entered a new economic normal and is now in a critical period of economic transformation and development, with economic growth gradually shifting from factor-driven to innovation-driven. Under this new normal of slowing economic growth, return on investment for financial and non-financial enterprises differs. The profit-seeking nature of capital has led to a shift away from the real economy toward capital and real estate markets, in which capital turnover is faster, a phenomenon as known as enterprise financialization. At the same time, from the risk control perspective, when considering firms' allocation of financial assets, it is necessary to explore their financial risk. R&D and innovation activities require more capital than fixed asset investments and face high adjustment costs in the event of disruption. Innovation activities are also risky, unstable, and the result in intangible assets that are difficult to collateralize, means that firms are often constrained by the financing environment and have an incentive to smooth out R&D innovation. When firms rely too heavily on the financial sector for their revenue streams, the inevitability changes managers' capital investment professions. Hence, it's rational that long-cycle, high-risk technological environment activities are rejected by firms. The allocation of more capital to the financial sector has a significant substitution effect, subject to resource investment constraints. This paper makes 2 main contributions. First, it examines the impact of the incentive to hold financial assets and financial risk on innovation activities at the firm level, and examines the heterogeneity of the impact mechanism between types of firms. Second, this study measures the impacts of firms' allocation of financial assets on their innovation activities at 2 levels, and explains the impact of financial risk on innovation due to the allocation of financial assets. Now, part 2, background and hypothesis. 2.1. The incentive to hold financial assets and innovation activities. According to Markowitz's portfolio theory, under fixed financing constraints, increasing the allocation of financial assets reduces the funds available for other activities. Chinese A-share non-financial listed companies tend to exhibit a negative correlation between corporate financialization and innovation investment, and their opportunity motive is greatly enhanced, and financial channel profits have only a discouraging effect on innovation investment in both current and future periods. Based on Jin's theory, if management is keen to profit through financial channels, it will divert attention from the real economy, leading to less attention to long-term corporate development and innovation. Based on the above research, the following hypothesis is proposed. H1. A higher incentive to hold financial assets has a greater inhibitory effect on innovation activities. 2.2. Financial risk and innovation activities. The financial stability of enterprises is critical for their technological innovation activities. The funds for the R&D expenditure of enterprises mainly come from two paths: internal cash flow from production and operations, and external financing environment brought about by development of financial markets. Based on Jin's theory, as firms' financial risk increase, they become more cautious in their business activities, preferring projects with stable, low-risk returns, and thus scaling back innovation activities with long lead time, high risk, and slow capital turnover. Therefore, this study proposes the following hypothesis. H2. Higher financial risk has a greater inhibitory effect on a firm's innovation activities. From here is the analysis of heterogeneity. As the impact of an enterprise's allocation of financial assets and financial risk on innovation investment can differ, it is necessary to distinguish firms according to their individual characteristics that have been shown to be the main factors affecting innovation activities. There are two main factors in this paper: ownership types and technological level. First, the different ownership types of enterprises may affect the relationship between the allocation of financial assets and their innovation activities. Moreover, SOEs can obtain lower-cost financing more easily than non-SOEs. They do not have a strong incentive to hold financial assets with larger returns. Based on the above analysis, this study proposes the following hypothesis. H321 SOE's incentive to hold financial assets has a smaller inhibitory effect on innovation activities than that of non-SOEs. H322. The financial risk of SOEs has a less inhibitory effect on innovation activities than that of non-SOEs. The technological level. As the innovation of high-tech industries is higher than that of low-tech industries, the enterprises have a good innovation foundation. Thus, an increase in financial assets allocation has less impact on their normal innovation activities. But low-tech industries, whose business activities are more oriented to traditional markets, are less active and policy-driven in their environmental activities than high-tech industries. Under the market profit orientation, they are more likely to shift their limited resources from technology R&D to capital market. Based on the above analysis, the following hypotheses are proposed. H421. The incentive to hold financial assets has a lower inhibitory effect on the innovation activities of high-tech firms than those of low-tech firms. H422. Financial risk has a great inhibitory effect on the innovation activities of high-tech firms than those of low-tech firms. Part 3. Data and variables. Given the implementation of new accounting standards in China in 2007, global financial crisis in 2008, large and unstable changes in enterprises, financial indicators, and allocation of financial assets, we simply listed complex from 2009 to 2019. Our data are obtained from the SISMA database. To reduce the inflation of outliers, the variables are visualized at the upper and lower 1% levels. Further, the continuous variables are shown as logarithms to reduce the influence of heteroscedasticity. Now this table is about the variables. The dependent variable is an enterprise's innovation activities, denoted as LNN, which is measured by the proportion of net intangible assets as a percentage of total assets. In this paper, there are two independent variables. FAI stands for the incentive to hold financial assets, which refers to a firm's earning through the financial assets channel. This paper measures it using the ratio of financial assets profitability to operating profit. Learn EMI score denote financial risk. This paper uses Altman's emerging market scores model to measure financial risk. In this study, firms' ownership types and technological level are selected as the moderating variables. Following the literature, this paper adds a series of variables that may affect a firm's innovation activities. In this table, we can see how the control variables are measured. Further, we introduce time-fixed effects and industry-fixed effects. Part 4. Research model. First, the mean effect. To analyze the impact of enterprises' incentive to hold financial assets and financial risk on their innovation activities, this study sets the following panel econometric model, where the subscripts I and T denotes the enterprises and period. LNN denotes innovation activities. FAI denotes the incentive to hold financial assets, which is traded with one period lag to avoid ingenuity and reverse causality problems. and consider the lagged effect of earning on innovation activity, and learn EMI score. DevOps denotes the financial risk of enterprises. Control denotes the series of control variables. Effect innovation. In addition, individual fixed effects mu-I and time-fixed effects gamma-T are considered to eliminate the effect of time invariant firm characteristics and macroeconomic environments. Then, moderating. To further verify the roles of a firm's ownership type in carrying out the effect of the incentive to hold financial assets and financial risk on innovation activities, the following model is constructed by adding the interaction term with firm's incentive to hold financial assets or financial risk into the benchmark model. In Model 4, if the coefficient beta 3 is positive and significant, it means that the incentive to hold financial assets has a weaker crowding out effect on innovation activities in SOEs than in non-SOEs. Similarly, Model 6, if the coefficient 6.3 in Model 6 is positive and significant, it indicates that financial risk has a weaker crowding out effect on innovation in SOEs than in non-SOEs. To further verify the moderating role of firms with different technological level in the crowding out effect of the incentive to hold financial assets and financial risk on innovation activities, the following model is constructed by adding the interaction term with firm's incentive to hold financial assets or financial risk into the benchmark model. From Model 7 to Model 10. In Model 8, if the coefficient phi3 is positive and significant, it indicates that a higher incentive to hold financial assets in high-tech firms has less crowding out effects on innovation activities than in low-tech ones. Similarly, in Model 10, if the coefficient lambda 3 is negative and significant, it indicates that higher financial risk in high-tech firms has a greater crowding out effect on innovation activities than in low-tech enterprises. Part 5. The results. First, look at the descriptive statistics. As can be seen through Tab 2, the simple data fit the statistical characteristics. Tab 3. Tab 3 shows the Pearson correlation coefficients of the mean variables. The correlation coefficients of the incentive to hold financial asset FAI and financial risk learn EMI score with LNN minus 0.058. and minus 0.114, which supports the previous hypothesis. Then look at the Table 4. Table 4 shows the result of the roles of the incentive to hold financial asset, financial risk, and innovation activities. According to the result of the Hausman test, the p-value is less than 0.05. Hence, we select the fixed effect regression, as shown in Model 1. The coefficients of FAI is minus 0.02, which is significant at 5% level. This indicates that such an incentive has a significant inhibitory effect on innovation activities, supporting hypothesis 1. Model 2 present the regression results of financial risk and innovation activities. The coefficient of financial risk in Model 2 is minus 0.722, which is significant at 1% level, indicating that an increasing in financial risk significantly reduces the number of innovation activities, which supports hypothesis 2. Table 5 present the regression result of the interaction term between a firm's ownership tab and the incentive to hold financial assets and financial risk. The covariance of the lagged term of the incentive to hold financial assets in Model 4 is minus 0.071. The coefficient of ownership tab is 0.044, and the coefficient of interaction term of the incentive to hold financial assets and ownership tab is 0.05, significantly at 10% level. Compared with Model 3, the escrow and adjusted escrow of Model 4 increase, which shows that ownership tab moderates the carrying out effect of the incentive to hold financial assets on firms' innovation, and that the carrying out effect of the incentive to hold financial assets on innovation activities is weaker in SOEs than in non-SOEs, supporting hypothesis 3 to 1. In Model 6, the covariance of the interaction term is 0.08 at the 10% level. Compared with Model 5, the escrow and adjusted escrow increase, which shows that ownership tab moderates the inhibitory effect of financial risk on innovation activities, and that the crowding out effect of incentive to hold financial assets on innovation activities is smaller in SOEs than in non-SOEs, supporting hypothesis 3 to 2. Table 6. Table 6 present the regulation result of the interaction term of a firm technology level with the incentive to hold financial assets and financial risk. In Model 8, the coefficient of the interaction term of technological level with the lagged term of the incentive to hold financial assets is 0.123, significant at 1% level. It's higher than it of Model 7, with significantly higher escrow and adjusted escrow values. Hence, a firm's technological level has a stronger moderating effect in the incentive to hold financial assets on innovation activities, and the crowding out effect of the innovation incentive to hold financial assets on innovation activities is smaller in high-tech firms than in low-tech ones, supporting hypothesis 4.421. In Model 10, the covariance of the interaction term is minus 0.157, significant at the 1% level, compared with Model 9. The escrow and adjusted escrow value are significantly higher, showing that a firm's technological level has a greater inhibitory effect on the innovation activities of high-tech firms than those of low-tech ones, supporting hypothesis 4-2. The last part, conclusion and policy recommendations. Then look at the picture. This study examines the impact of the allocation of financial assets on non-financial enterprises' innovation activities. The empirical results show that the incentive to hold financial assets has a significant crowding out effect on innovation activities, and that financial risk hampers innovation. Further, we find a moderating effect of a firm's ownership type and technological level in the above relationship. First, when classified by ownership types, the crowding out effect of the incentive to hold financial assets and financial risk on innovation activities is relatively weak in SOEs. Second, when classified by technological level, the inhibitory effect of the incentive to hold financial assets on innovation activities is not obvious among enterprises in high-tech industries, whereas the effect of financial risk on innovation activities is stronger. The crowding out effect of the incentive to hold financial assets on innovation activities is stronger in low-tech enterprises, and the effect of financial risk on innovation activities is weaker than that in high-tech firms. Based on the empirical finding, as well as the real-world program challenging economic development, this paper proposes the following recommendations at the levels of both government and enterprises. First, on government level, the government should improve the financial regulatory system to prevent systemic financial risk. Second, optimize innovation incentive policies to guide enterprises